Hey guys, welcome to Muffett Investment Views. Today we are reviewing Steel Dynamics stock. We have already reviewed this stock in a previous video. We are going to do a very short outlook on Steel Dynamics stock and then look at option strategies that can be employed. Options are a great way to improve portfolio returns if we use them in the right way. Steel Dynamics is an American steel and aluminum producer listed in NASDAQ. It has a great management and has shown remarkable growth in the last 20 years. It will benefit from geopolitical fragmentation that is happening currently in the evolving geopolitical scenario. It also benefits from low energy costs in the US compared to steel makers in Europe and is protected by tariffs from low-cost Chinese imports. Financial metrics. Share price, $120. Market cap, $18.9 billion. Price-earnings ratio, 8.23. Dividend yield, 1.52%. Debt, $1.6 billion. The revenue has grown from $9 billion to $18 billion. Net income has grown from $550 million to $2.3 billion. If we look at the Steel Dynamics stock chart, it has been in a long-term uptrend. However, more recently, we have seen weakness. While NASDAQ and S&P have made new highs, Steel Dynamics stock has not and shows underlying weakness. This is most likely reflecting slowing economic growth due to Fed rate hikes. So we have a good chance that Steel Dynamics stock can fall below $100 when NASDAQ and S&P correct. We think that it would be a good place to accumulate the stock at around $100. If you are enjoying this video, we would be grateful if you could kindly subscribe and like this video to help support the channel. Using options to leverage portfolio returns. Options are complex strategies and also leveraged. So it is important that you spend time learning about options and practicing in a paper account before embarking on options with real money. We would advise that you have a mentor to help understand the various intricacies involved. There are many different option strategies that can be used. But here at Muffett Investments, we think that 3 strategies are more than enough. Here we outline 2 of these strategies involving Steel Dynamics stock. These strategies involve selling of the options. When we sell options, we collect the premium associated with that option, and we have an obligation to either buy or sell the underlying share at the strike price at which we sold the options. So if you sell a call option, you are obliged to sell stock at a particular price, and if you sell a put option, then you are obliged to buy the stock at the strike price. The following are the options chain of Steel Dynamics stocks with January 2026 expiry. We will refer to these again when we go through the strategies. Option strategy 1. Selling put options to buy stock at a lower price. Consider a scenario where you expect the stock to fall or you want to buy the stock at lower levels. Then we can sell put options on the stock at a price that you would be happy to buy. By selling the put option, you collect the premium associated with the option sale and you have an obligation to buy 100 shares of the stock at the strike price. For example, if you as an investor believe that Steel Dynamics stock will fall and want to buy the stock at $100, then you sell a put option with a $100 strike price and receive a $7.70 premium. This you can see from the put option chain. If the stock falls to $100 or below at the expiration date, then you are obliged to buy 100 shares at $100. However, because you have already collected a $7.70 premium, you effectively buy the stock at $92.30. If the stock stays above $100, the sold put option expires worthless and keep the premium collected. We can then go on to sell another put again at a desired strike price and collect more premium. So we can use this strategy not only to buy stock at a lower price but also as a source of income. The risks with this strategy is that if for whatever reason Steel Dynamics stock suddenly falls to $70, if you have sold the put option at $100, you are still obliged to buy the stock at $100, potentially leaving you with a big paper loss. That is why it is important to do proper research and due diligence on a stock before selling put options. It is important not to use this strategy indiscriminately to all stocks and only sell put options on stocks you really want to own over the long term. It is also important to remember that you should have enough funds to buy 100 shares of that stock before selling the put option. Option strategy 2. The butterfly strategy. This strategy involves buying a stock that you like and simultaneously selling calls and puts around it. This strategy is a way of accumulating a stock over the long term and also leverages options income. If used over a long time, it can compound at astonishing rates. We will give an example of this strategy with Steel Dynamics. This strategy is particularly suited for dividend stocks as a way of increasing dividend income. Buy 100 shares of Steel Dynamics at $120. Sell a January 2026 $125 call, $28. By selling this option, you collect the $28 premium and an obligation to sell the stock at $125. Sell a January 2026 $100 put, $7.70. By selling this put option, you collect the $7.70 and an obligation to buy the stock at $100. Total option premium collected is $28 plus $7.70 equals $35.70. Now, why would you want to use this strategy? The main idea here is that by selling premium, we are being the house in a casino. In a casino, the house always wins. We sell options as most options expire worthless. Here we are selling two options, a call option and a put option, and in 2026 there can be three scenarios. Scenario 1, stock is between $125 and $100. In this case, both the sold options expire worthless. You own the stock and you also collected the dividends, but you have also collected the premium, which is an income equivalent to 30% over 2 years. From a probability standpoint, the chances of this happening is 1/3. Scenario 2, stock is above $125 in 2026. Here the stock could be potentially called away. If you look at it, you have collected $35 and you are selling the stock at a $5 premium compared to when it was bought, and the total gain is $40. Even though your stock is taken away, you have gained 30% in 2 years. The chances of this happening is 1/3. Another thing to consider here is the call buyer will only benefit if the price of the stock is above $150. So most of the time, as long as the price is below $150, your stock may not be called away. Scenario 3. The stock is below $100. The sold call option expires worthless. The long position of the stock is down by more than 20%, and the sold put option obligates you to buy 100 shares of Steel Dynamics at $100. This is where doing your due diligence is important. You should be happy to buy the stock at lower levels, otherwise you should not be employing this strategy. If you have been very confident with your research, then you would be happy to buy a further 100 shares at a lower price. Now you have 200 shares and you employ the same strategy again by selling puts and calls around the stock. Over the long term, the accumulated premium will add to the gains and compound at a much faster rate than using a strategy which involves stocks alone. The chances of this happening is 1/3. So overall, in 2/3 of the time, you win, which is a big edge, and in the 1/3 of the time that you lose, provided the stock doesn't fall too much and you have done proper research, you will win the next time. There is always a small chance that your research is wrong and the stock has fallen too much for your liking, in which case you cut your losses and move on to the next. The idea here is to be the house and not the gambler. In a casino, the house always wins in the long term. This is because it has an extra green. This gives the house an edge. This, when played over and over, is how the casino makes its money. So the more games people play, the more likely the casino is going to make the money. We do the same thing here. We do our research on the stocks we like to own and set up options positions like this. Einstein said that compound interest is the 8th wonder of the world. In investing, compounding is one of the most important strategies to grow wealth. Even a 2 to 3% increase in returns compounded over the long term makes a huge difference in the final capital. So when this strategy is used wisely, it can enhance your returns. The Steel Dynamics options ideas are not investment advice. It was used as a real-time example of how to use this option strategy. We hope you like this video, and we would be grateful if you could like, subscribe, and